Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thanks for joining us today as we take a look at can the U.S. consumer keep the world economy afloat. Now, with us for the presentation is going to be Robert Johnson, a CFA who is the Director of Economic Analysis with Morningstar. Bob has more than 20 years of investment experience, including both buy-side and sell-side assignments as a research analyst. He also holds an MBA from Harvard University and is the CFA charter holder and a member of the Investment Analyst Society of Chicago. So would you please, everyone, join me in welcoming Bob Johnson for today's event. Well, thanks, Bob. Thanks for joining us. I'm going to actually move this over to your slides, pass you the ball, and let's get started.
Okay, Cynthia, thank you so much for that introduction. We've got a lot to cover today, and I'm very excited to be talking about it. The first thing I'm going to do is talk about the question I ask, can the U.S. consumer keep the world economy afloat? I'm going to, instead of waiting to the end to answer, that's going to be the first thing I do. Then I'm going to focus on the U.S. economy for a while and talk about what's been driving the economy for the past several years, and then take a look at our outlook for the next few years going forward. And obviously a key driver of all of that and why I remain very optimistic about the economy despite all the pressures we're seeing out there right now is because of the consumer. So we're going to drill down a little deeper on the consumer, and then we'll talk about some of the other categories of GDP a little bit to talk about how they're all doing, and we'll take a look at the worries that are out there. Then I'm going to come back and talk about the residential housing market just for a bit, because I think that's a key point about why we've got more room to grow in the economy. And then I'm going to come back and talk about the overall world economy, not just the U.S., to kind of set things in a little bit of a context. And then we're going to talk about demographics, which I think is absolutely maybe the most unique part of my presentation, and also what's really driving things and what people are kind of not understanding in the economy. Everybody's kind of so focused on the Fed or which statistic is up or down. And I think that people need to take a longer view, and the demographics is driving a lot of what's out there. And I want to spend some time on that. And finally, with all the market activity today, I may add a couple of words at the end about, what's going on if I'm relatively okay with the economy, what the heck is going on with the stock market the last few weeks. And I'll talk a little bit about that. Nobody knows any answers to that, but I'll give you a few things that I think are operating there. So let's go to the first slide and talk about the U.S. In the world economy. One thing that's very clear is that there's a lot besides the U.S. in the economy. The U.S., you could tell in the red section there on this graph at 22%, is only one part of the economy, the world economy, that it's clearly China has taken a bigger role these days. Europe maintains its pretty good share. And there's even a sizable amount of other. But you can see that China, and you put Europe all together, and the U.S. do account for a great deal of the world economy. And I think that's something that a lot of people miss. I think China has grown so fast over the last few years. Their part of that pie has grown very, very rapidly, and will continue probably to grow rapidly. Even in a slowing world environment, they're still likely to grow relatively quickly and gain a greater share of that pie. So the U.S. is not alone. What's interesting, one other point about this is if I went back to the 1920s, the U.S. was also about 25% of the economy. So it's kind of interesting. The number of other players have changed around rather dramatically, but it's kind of interesting that the U.S. in total is kind of held its share, if you will, which is, I think, always a fascinating thing when you look back at the data. You think we'd be continuously shrinking, but actually we maintain a relatively good share. So certainly our size gives us some potential to help the economy, but we're certainly not the only game in town. Now we'll take a look at the next slide. Now we're going to look at it a slightly different way, and there you can see the U.S. stands out there in the red bar as being one of the bigger importer countries. In other words, it does make a difference there, but unfortunately you can see what's even more important is the gray other section, kind of emerging markets, if you will, trading amongst themselves is by far the biggest share. So certainly the quick answer to my question is, yeah, the U.S. may be able to help out because of its sheer size, help out the rest of the world, and we're certainly a more consumption-oriented economy, and we certainly import more than, say, a China or than Europe does as a relative percentage. But on the other hand, it's what emerging markets and other markets trade amongst themselves. It's going to be the real true driver. So the U.S. cannot totally save the day is my conclusion on that point. It can certainly help, but it's not the savior. And unfortunately, the U.S. is not actually doing as well import-wise as the rest of the world would like us to be doing. So now let's go and talk about the U.S. economy. Just how is it doing? If it's kind of big and at least some importance, how is it doing? Well, I would focus everybody here on the last column here of GDP growth. Those growth rates are all kind of, let's take a full year, kind of all the winters, all the summers, kind of stripping out the seasonal effects. How has the economy done? Well, I've only put 4 years here. If I'd gone back further, I would have still gotten the same conclusion. We're pretty well stuck in this 2 to 2.5% growth rate, and it's been very steady, very consistent. And, people get so scared about these quarterly numbers. And now if we take a look at the middle batch of numbers, you can see that the GDP has ranged from minus 0.9% one quarter to kind of numbers over 4% in another quarter. So they're kind of all over the board, and everybody kind of really focuses on those numbers and really gets scared about them. But, a lot of that has got to do with some interesting things. We'll talk about them a little bit longer, but the stability of the U.S. economy and this continuous stable growth rate, I think, is deeply underappreciated. I call it the ocean liner economy because it's very difficult to change speed or direction in an economy that this large and has as big a base as it does. And I think that we all get wrapped up in talking about these quarterly numbers and who's going to guess what the next quarter's growth rate is going to be. But the stability is pretty incredible there. I will add that growth rate is longer at 2 to 2.5% is lower than the 3.1% average of the last 50 years. And we'll talk about why that's lower in some subsequent slides, but we'll acknowledge that growth rate is indeed lower than what it has been over the long term, but also exceptionally stable. So why have the numbers been so erratic? Why do we have these -1s and the +4s? What's going on? Well, some of the data is weather related. We've had some winters that are unusually warm and some winters that are unusually cold, and either extreme seems to be driving the statistics nuts. Warm weather seems to slow clothing sales and seasonal things, and cold weather, nobody can get out to a store. We kind of need the weather a little bit more like a normal thing, not at either extreme. One extreme is as bad as the other, and certainly we've had a few years where weather has driven down first quarter numbers like crazy. And unfortunately, that pattern may continue, and we're going to see some of that here in the fourth quarter, and we'll talk a little bit about that. Last year's first quarter number was greatly impacted by a West Coast port strike. How did that happen? Well, we import a lot of goods, and some people raced to ship those goods in before the strike took hold, and then other people, once the strike was over, raced to bring the stuff in, and that made certain quarters look really strong and others look really weak, but you kind of averaged them together, and we were okay. And so that moved the numbers around. Sometimes tax law changes, or when the Social Security increase kicks in, or whatever happens in slightly different times or in slightly different amounts. Like this year, there's no Social Security adjustment. That may weigh on some of the first quarter numbers. So there's a lot of things out there that affects the numbers, and just in general, the seasonal adjustment factors that are used in those quarter-to-quarter numbers are very, very suspect. In so many of our numbers now are looking at year-over-year growth rates averaged over 3-month periods because the seasonal adjustment factors have just gone crazy. And, you don't want the government statisticians kind of, oh, yeah, we feel this is a little better, and, yeah, it was a little cold, let's adjust that. You don't want it to be willy-nilly control So all they can do is kind of take averages over 20-year periods, and they have to use a fairly long period of time to do that. But sometimes things change faster than the rest of the world, and they can't capture them with the seasonal adjustment factors. The auto industry is driving the statisticians nuts. They've gone through a period where, they used to shut down for 3 weeks, every July, every manufacturer. And over the last few years, they've gone to a pattern like when we came out of the recession. None of them had a summer shutdown. They all kind of worked around it, maybe a week off here, a week off there, but certainly no big shutdown. And then after things got back to normal, some had an August shutdown, some had a July shutdown. They're not allowed to change those seasonal factors because Ford called them up and said, yeah, we're doing this for 3 weeks. And I can go on and on about them. That's one that seems almost obvious to adjust for, that they just haven't, and it's driving the auto numbers so they look like they're, like we didn't produce any autos in December, and we had a boom in July, and it just really drives things nuts. Even on the employment side, I was fascinated. I read something from Challenger Gray, the outplacement people, and it was fascinating that between 2000 and 2008, a huge portion of layoffs happened right at the end of the year as people right-sized and tried to get the people out the door by the end of the year and so forth. And now, as we look from 2008 to 2016, employers are refusing to lay off anybody December in the middle of the holidays. Just a complete sea change, but yet in the 20-year adjustment factor, they have to include those 2000 through 2008 period. So that's what I mean in those recurring factors, those faulty seasonal factors that I talked about. And certainly some of what's happening in the energy industry is affecting things, and certainly the levels of corporate inventories. We're very backwards as economists on how we calculate stuff. GDP, gross domestic product, it's what we actually produce. You'd think we'd actually go out and count everybody and ask them what they produce, but instead we kind of come at it backwards. We ask stores how much they sell, and then we back into how much, and we figure out how much inventories change, and we back into how much was produced. And it's kind of a backwards way to do it. And as a former auditor, I really hate that because the inventories are volatile, they're hard to count, they drove us nuts as auditors. If you were in 1% or 2%, you felt pretty good. And yet they make huge swings. If you see these big GDP swings, almost every quarter has the really big swings in one direction or the other are based on inventory. And what's interesting, if you look at the data over a full year, inventories are seldom a very big contributor to GDP. They hardly make a difference. The good quarters cancel the bad quarters. And unfortunately, here in the fourth quarter, again, nobody knows. There's too many factors that goes into the inventory calculation to say with any certainty. But it certainly appears that inventories are going to be another big drag again here in the fourth quarter, which unfortunately is going to bring down the GDP growth rate. So that addresses why have we been so erratic in terms of our performance. Why does it look so bad quarter to quarter, when in reality it isn't, when you look at just a slightly longer period of time. But now I want to address a little bit, but why has it been slow? We're going to, at the end, talk more about demographics, but just a real quick shot here at it's an aging population that we have right now, and there's fewer of us. Back when the economy was growing 3 or 4% in the 1950s and 60s, we had a population growth that was pushing 2%. 4% growth, 2% population. Well, where are we at now? Population growth is down to 0.7%, going to 0.5%. Meanwhile, GDP has also fallen over that same time, and you can see, we'll show you some of the correlations later. But so much of what we're seeing is not like, oh, we're terrible, we've lost our way, we're losing out to China. No, it's a population thing. And again, it's compounded by the fact that not only is it slowing, but it's an older population. Older populations tend to spend less. They spend differently. They spend on health care. They spend on travel. They don't tend to spend as much money on clothes and retail goods. and an older population in general consumes less. And so that's affecting a lot of the numbers. The third point there is government. Government spending used to be one, as fast as the economy grew, the government grew almost as fast. But now government, for the first 3 or 4 years of the recovery, actually detracted from GDP and actually shrunk the number of government employees. Some of that had to do with phasing down some of our military operations. And we saw a similar thing for a quarter or two during the Vietnam War and the Korean War. But again, this is kind of unprecedented to last as long as it has. And it's not just the federal government, although that's certainly a big part of it, but even local governments haven't been spending so much. And I think so much of that is probably related to the fact that the housing market isn't growing like it once was. Frankly, we were adding 3 times as many houses in the early 2000s as we are now. And all those houses needed more sewers, more schools, more government services, and now housing is growing at a much slower rate. And that certainly impacted government spending as well. And government spending is important. It's 15% of the economy, and until very recently, it's been shrinking. So that certainly limited the growth. I won't spend a lot of time talking about income inequality. Hasn't helped a lot. We certainly, more money is flowing to richer people, more money is flowing to corporations that have huge cash balances like Google and so forth, and that money isn't necessarily being spent. People with lower incomes and individuals tend to spend every dollar they get. Instead, the money now, and the cash in society, is generally flowing to people that are bigger savers, and that's certainly not helping the data. Now, as we look forward on some of our data, I'm continuing to expect the ocean liner economy, 2 to 2.5% GDP growth again this year, with probably the emphasis right down the middle of that range. That'll be very similar to the 2.4% that I'm expecting to get for 2015. I think inflation might be a little higher. I've kind of noted headline inflation there at 2.5%. The core inflation will be slightly higher, but I think energy prices, just because they can't keep going down, and maybe they will, maybe I'm wrong on that, but I'm a little bit higher than most people with that 2.5% inflation outlook. And again, that's December to December, and I who knows, but I believe gasoline prices may be a bit higher this next December than they were just now, just because we're getting to a point where the cost of doing something is almost where the price is. And by the way, my GDP forecast is probably just a tad below consensus. Last year, starting 2015, I was way below consensus. This year, I'm just a tad below. Employment growth remains relatively strong at 220,000 jobs a month. Again, we closed the year on a very high note, averaging 280,000 jobs. Again, the seasonal factors screwed things up a little bit. So I'm expecting the employment reports not to look as good as they did in October, November, December in the months ahead. But I think overall, the average number of employees added per month will be nearly identical in 2016 as it was in 2015. However, because of an aging population, I think the unemployment rate will probably drop again, maybe to as low as, I say 4.6 to 4.8, but it could drop to even 4.5%. I expect interest rates to be higher. This, again, is a very off consensus view, and it's certainly not what's being reflected today in the market. But I'm feeling as inflation creeps higher, as underlying core inflation becomes more visible, I would expect that those rates may move higher, but in all fairness, I've been thinking they'd move higher for the last 2 or 3 years and have been entirely wrong on that. And also, I expect home price appreciation to remain strong at about 6%, probably just a little bit higher than a year ago, and that's good news and bad news. It really wrecks housing affordability, especially if rates are a little higher, which may keep a little bit of a cap on that sector. We'll talk about that a little bit more in some future slides. What's going to be the driver in my forecast? It's all about the consumer. Almost all of the growth that we're going to get is from the consumer. I think the government may be less of a drag than it's been in the past few years when it's actually been negative, so it's actually going to help the numbers a little bit. I I think the housing market will continue to be additive to the economy as it has been for several years now, but I don't expect it to happen at an accelerating rate because there just isn't enough available land and available workers to make that number accelerate much. I think low commodity inflation is going to driving this forecast is a big help for consumers and consumption. It's kind of bad news for business and business spending. And speaking of that, I think business spending certainly had a tough year this year, much of it related to investments relative to oil spending. But I also think that just with an overall slowing world economy, they don't need as much raw capacity as they used to, and I think that's kind of weighing on that business spending number. I think we might stabilize a bit here, but I don't think it's not going to be the hero of this 2016. And exports, I think, will probably stabilize a little bit in here. We've certainly had a tough couple quarters in terms of exports. I think that as certain categories of exports begin to do a little bit better, they'll offset some of the weakness that we've seen in some of the more heavy equipment-related and commodities-related things. I'm talking here about pharmaceuticals. I'm talking foodstuffs. Those are things that may act a little better and may offset what I think will be continuing issues in that commodity complex, if you will. Okay, first of all, turning to the consumer. The consumer is 70% of the economy. You can take the growth rate of how fast you think the consumer is going to grow and multiply it by 0.7, and you'll get pretty darn close to where I think the economy might be. And you can see, again, it's kind of spread over time, but the consumption rate's been pretty steady. It's kind of been in a narrow range of 2 to 3%. You know, you've seen these big jumps in GDP and people talking about all these big ups and big downs and how volatile we are. You know, frankly, consumption has been pretty healthy this entire recovery, kind of being, you know, wavering on weather and tax breaks and whatever, wandering kind of between 2 and 3% for some time. And, yeah, the consumption numbers right now look just a little softer than they've been. They're not at kind of their peak levels. And I think we could probably back off just a little bit more on that consumption number. But I think the consumer, in general, is relatively healthy. Inflation adjusted, growing right around that 3% mark, likely to probably fall into something that looks more like 2.5% over the year ahead. What's driving that? Certainly, we've added more employment, and you know that's the fundamental fuel for growing an economy is incomes, and that's driven by employment. And again, you can see that same pattern there where it's been rock steady growth. You know, it's another indicator that you know the GDP growth numbers, that those sequential numbers that we all like to talk about are kind of worthless, because you can see that the employment numbers more echo those yearly numbers I showed you, and it's been very steady at kind of 2% or so growth in employment. And again, that's a number that fits real well with our employment forecast, or with our GDP forecast, because GDP usually grows a little bit faster than employment. So this is the underlying fuel for all that consumer spending, and you know, we remain rock steady there. That's why we aren't panicking in here. Let's take a look at the next slide. Not only are there more workers, but each of them are being paid more per hour. Despite all of what you may read in the press about wages not going up, we adjust those wages for inflation on an hourly basis, and you can see the trend there has been exceptionally positive the last few years. Again, as inflation comes up a little bit, I don't think those numbers will look quite as positive in 2016, but those numbers are pretty powerful. And by the way, a lot of people get very confused on these wage data, and so many people say, oh, they're horrible, they've never been this bad, oh, nobody's gotten a raise for years. A lot of this has to do with certain mix issues that are going on, and confusion about how to factor in inflation. You know, people may remember years of 4 or 5% raises, and that's what they're kind of harking back to think this is such a disaster. But keep in mind that during that time, inflation might have been 3, 4, 5, 6%, and therefore the consumers weren't getting any further ahead on an inflation-adjusted basis than they are right now. I will say oil is artificially depressing some of the inflation numbers right now, which makes that number look a little high. But if you went back to a 30 or 40-year period, that wage growth that we're seeing right now is stronger than any time than we've seen in the last 30 or 40 years. Again, it's a little bit artificial because of the energy situation, but certainly it's not like the 1980s when the consumers were making no progress at all for a 10-year period on the real wage. So this is not a new phenomenon. We didn't see it as much because they were able to borrow more. In the 1980s, it was actually more women entering the workforce, helped people think like they were richer. But certainly this wage growth, in addition to the employment growth, makes me feel better about the consumer. And that labor market isn't going to get any easier. I don't think those wages are about to fall off a cliff either, because we're kind of going back for a very long period of time. The number of new initial unemployment claims has fallen to probably, as a percentage of the population, one of the lowest levels we've seen. This particular graph only shows the last 8 years or so, but if I drew this over 50 years, that number has never been lower. The labor markets are indeed getting tight. Indeed, I'll make a very bold statement, and I think that employment right now is being held back by there not being enough employees, people that want to work, and not by corporations' willingness to hire. I think they'd all hire a lot more people if they could. And putting this all together, the green and the blue lines on that chart, the top line is wage growth. That's kind of a more, especially, that's kind of the average guy, if you will, the average person, the amount of money that they might have available, their wage income. The blue line is real disposable income. That's kind of includes rent, it includes dividends, it includes small business profits. So it's a little bit broader measure, but some of those people tend to save their money a little bit more, so it's not always necessarily the most indicative number out there. But in any case, those two lines have been trending upwards. They both, again, may back off just a little, but you can see the orange line there, that's that consumption graph that you've seen on all the other pages, just overlaid here, and it's that bottom graph, and you can certainly see there's been a little bit of an opening up. That spending has not kind of kept pace with the wages and the earnings, and that's one of the reasons for my optimism, that is, if consumers spend the money, have the money to spend, eventually they will spend it. They can have short-term periods where they don't spend so much, but they usually don't last too long, and so that's why I'm optimistic about the economy. And certainly, I would stress that low prices have really helped the consumer. On this graph, I show two things, though. You got to be careful, and I get beat up so many times when I say, well, there's no inflation. The guy says, well, you're not paying my health care bills, you're not paying my students' education loans, whatever. And you can see here that the core inflation is still trending down. That's the darker line, the blue line, I should say. And certainly that's remained about 2%, but still a lot lower than we were back in the 1980s. But where the real deflation has happened is in a lot of the food and energy categories, and you can see that's the lower line where we're near zero. And certainly that the goods inflation that we've seen, the food and energy price deflation, has been a good thing for the consumer, but we understand and are cognizant that it's not the be-all and end-all. If you don't buy a lot of gasoline or buy a lot of clothes or a lot of electronics, you may not be seeing all the benefits of the lower deflation out there. So it's a little bit of an offset. And again, it probably would have been a little bit more dramatic if I had put the consumer level of net worth, and certainly that's going to weigh on the market here a little bit over the on consumption a little bit in the months ahead, starting off the year so badly. But consumer net worth has kind of been on a tear since the recovery. We were in kind of the $50 trillion range for total net worth at the bottom of the recession, and right now, and that number's not on the graph, these are percentage changes, we're something like in the $80 trillion range now. A lot of that's kind of the improvement in the housing industry, the improvement in the stock market, as well as additional savings. And you roll all those together, the net worth number is pretty darn impressive. And people don't tend not to spend much of their net worth, but some small percentage kind of usually leaks back into consumption. We haven't really seen that this time around, so that's another reason for my optimism. You can see that growth rate. Again, you always have a remarkable improvement after a recession, and we're kind of in one of those stabilizing periods now. And again, that's a slowing growth rate, not an actual drop in the number that you're seeing there. And again, that makes me feel relatively good. Unfortunately, this start out here in December is making me feel a little less good. And on the offset, a little thing that's been holding the economy back, and again, I'd be very careful here. I mentioned for long periods of time that really the consumer wage-wise was not getting very far ahead of themselves, and that a lot of that was supplemented and buried by the fact that the debt grew by a huge amount. I mean, you can see at one point there in 2005, we were growing debt as fast, consumer debt as fast as 10%. I mean, that's just a huge and unsustainable number that really disguised some pretty dreadful real wage data. And now you can, in the recession, of course, we had all the deleveraging. And a lot of this is, frankly, mortgages going down is what's happened here. But you can see the growth in debt has been relatively minimal. And again, low debt's kind of usually a good thing, but you know, you need some optimal amount of debt. If we went to an all-cash society, growth rates would fall through the floor. Some level of debt is good. Too much debt's a disaster. And I think that we're probably on a little low side of the Goldilocks territory right now. And we've certainly seen things where credit's more available, such as autos do very well. Things where credit's still tight, like housing, remains under a fair amount of pressure. So I would argue that this loan growth number is also one of the things kind of holding us back, and we're seeing some liberalization in some categories and not so much in others. So we'll see how that all plays out. Again, I don't want to ever be back, see that graph over 10% again, but maybe a little bit more than we see right now would be helpful. So we've chatted a lot about the consumer, and again, that's 70% of the economy, and we think that wages, earnings, all of that will continue to drive that, and they'll do relatively well. Turning to something that isn't doing well as well, industrial production and manufacturing, which is only about 12% of the economy, has had one of its best recoveries on record here. And you can see after the recession the really nice bounce that we had in industrial production. If you're really fine-eyed about that, you can see that 2015 was kind of the flattening out of that growth trend. 2014 was a perfect year between the oil shale machinery, an auto industry that was really kicking it into gear. It was just a great year for manufacturing. Anything that could go right did. And we had one of the best years we've had in a long, long time in 2014, and now in 2015 we've kind of had a dreadful year. I think when all is said and done, we got the number this morning. I think we probably industrial production after growing 3 or 4% for a couple of years is now only at a 1% level, and maybe even the interim getting pretty close to zero. So that's certainly something that's holding us back a little bit now. That was a big help in previous years. If we look at the next slide, we can see a little bit of why that is. Global commodity prices are down, and a lot of our economic infrastructure is related to commodities processing. Companies like Deere in construction and farming equipment, Caterpillar in a lot of mining equipment, Joy Global in mining, all very dependent on the commodities world, and their prices continue to erode and will continue to hurt those sectors. On the other hand, some of what's going on in commodities is certainly a big help to the plastics industry, which continues to do very well. Pharmaceutical production continues to do very well. Boeing, has a order backlog that's the envy of the world that will continue to help move production along. So it's not all bad news on the manufacturing side. And I'm hoping we bottom out here relatively quickly, but certainly we saw the reports out in New York today that the manufacturing sector there seems to be in a modest depression. But again, I would guess that a lot of the steel and coal stuff related to the Buffalo, Pennsylvania area there are really buffeting the numbers, and metals have been one of the categories that have just been plain killed. So it's been a very negative number, but again, it's not the key driver of the economy. Business spending has been not a big help this recovery. You know, we did a little better coming out of the recession again, but, you know, never quite got to the levels we've seen in some of the other recoveries. And, you know, we'll talk about it, but it's this whole demographics thing. We don't need a lot of greenfield capacity anymore. And so many things that we are growing the fastest in the economy are not things that require a lot of capital expenditures. So this category is never a huge percentage of the GDP, but certainly it's had some nice volatile upswings that have really helped the economy along from time to time, and we just haven't gotten that boost this time around. And we can be somewhat critical of businesses for not investing in their futures, but on the other hand, in a world that isn't growing nearly as fast as it used to, in a world that's a lot more interested in services, this number isn't perhaps a total surprise. And again, government spending we talked about earlier, that it's just been a very slow grower. The good news is we finally, as you can see on the right-hand side of that graph, we've finally broken back into positive territory on government spending growth. And again, depending on your political views, you can view that as a good or a bad, but it's 15% of our economy, and when that's growing zero, that holds back a lot of the overall headline numbers we've talked about before. And again, it'll be a little better this year, but you know what, with all the tight budget constraints on there and more local government spending actually going for pensions, not to hiring workers or building buildings, it's not likely that that number is ever going to be kind of the big help to the GDP growth that it ever was, especially as housing still remains kind of in the doldrums. And we've talked about exports certainly not doing as well as they could. Certainly, we've even had a month or two where exports have been down. And again, I would argue that more that's related to the commodities complex not doing well, more than the fact that the U.S. isn't competitive anymore. You know, so much of our exports are related to Boeing and agriculture, and a lot of things that are kind of locked in, if you will. I don't think exports will necessarily get a lot worse, and I don't think that prices in a strong dollar really explain all that's going on there. It's just nobody needs a commodity. Nobody needs a mining machine anymore. You know, the U.S. dollar doesn't really make any difference. So anyway, exports won't be a big help this year either. And just in terms of risks, I mean, certainly, you know, the Russian situation is kind of out of the headlines right now, but what's going on there is still a concern. We've heard a lot about China's slowing, and we've talked about China slowing for a long time here at Morningstar. We still worry about what's going on in the Middle East and all the terrorism. That bottom slide indicates worries about shale oil being shipped by rail and the potential for a rail disaster, kind of knocking out that as a growth thing. I kept including that slide because oil shale has frankly been a train wreck, but for different reasons. It hasn't been the literal train wreck. It's been the wreck of kind of overproduction and now causing everybody to cut back a little bit. So it's turned up as a risk. A risk has come true, but in a far different way than we kind of anticipated. And it certainly is, shale oil has been one of the secret sauces that has made this recovery a little bit stronger than people realize. Changing gears a little bit, talking about residential construction. Let's go to the next slide. One thing here is that residential construction and residential spending in general has averaged about 5% of GDP. You can see a couple peaks there where it's been up to 6 or 7%. Right now we're at only 3. There's a lot of headway room, I think, on that to move ahead. That's one of the reasons I'm optimistic that we're not at the end of this recovery. This is something that's got a little bit more room for improvement yet. And I think that it's not going to be instantaneous. There's some factors holding the housing economy back, but I wouldn't, this is a sector that I think will continue to grow. Unfortunately, as a contribution to GDP, I don't think it's going to accelerate, but it's certainly something that will help move the economy forward. And kind of continued growth there will help offset some of the export things, some of the lumber stuff electricity, copper, the things that are kind of some of the problems in China, will be offset by a little bit more growth here, hopefully. And this is just a graph showing that the inventories of existing homes are very, very tight. That's probably going to cause prices to move up a little bit, and it's kind of held back the sale of existing homes. There just isn't enough available property for sale right now, which is an interesting problem. And now young families are having a hard time getting their first starter home because there's literally nothing on the market right now. And housing starts, if you look at both those lines, both the single and the multifamily, they both continue to move upward. It's interesting that bottom green line shows that there's certainly been a lot more interest in apartments than past recoveries. That apartment building has now increased to the highest level that it's ever been in history. While the meantime, that red line is, well, nowhere near that big peak. We're better. It's certainly been a help to the economy. But so we're certainly nowhere back where we were, which kind of compounds the less lumber, less commodities, a lot less things than we saw in past recoveries. So it's certainly been one of the things holding us back a little bit. And certainly home prices have accelerated, which is good news because it's got everybody out from underneath their underwater mortgages, almost everybody. I mean, Nevada, Miami, parts of Arizona still certainly have issues, but clearly the price acceleration has helped a little bit, but on the other hand, it's hurting that first-time home buyer that we talked about, and that's been a bigger concern. And we finally plot this number for the final number of 2015. That FHFA home price index is going to be a lot closer to 6% again, which gets a little worrisome, again, for that first-time home buyer. Now let's back off. We've talked about the U.S. economy. The stable U.S. consumer is likely to keep the U.S. market moving along, but what about the rest of the world? What's going on there? Well, again, I would probably argue, well, maybe some of the numbers, and again, if you think about this chart, it's kind of some of the developed numbers on top, some of the BRICS and the more emerging market economies in the middle, and kind of rolling them a little bit together on the bottom between developing and emerging. You can see a little bit of what's going on there, and certainly the developed market, that is the United States, Europe, and Japan, the trends all there are looking a little bit more positive than they have been. Especially look at the Eurozone there, kind of. They were in a recession a couple of years ago. That's not on the chart, and they grew 1% almost, and now 1.5% this year, a little bit more next year. The United States, kind of the same growth every year. Although everybody hopes it grows faster the next year, it never quite really does, and I think we'll be stuck in that 2 to 2.5%. I think that's probably a little bit aggressive on there. Meanwhile, the emerging markets, especially ones that are commodity related, Brazil and Russia, have taken a shellacking. And I think some of those numbers still might be too optimistic. On the other hand, India, which is a big commodities user, has actually done very well. So you can't lump all the emerging markets together. And China, while not growing as fast as it has, is certainly a key driver of growth too. But certainly things are converging a little bit. And again, some of the population, and if you look at the combined world growth numbers, you can see what's happening there. That emerging had a really bad year in 2015, pulling down the overall world growth rate, that very bottom line of your chart there, to 3.1%. There's expectations that it's going to accelerate a little bit next year, but again, that kind of remains to be seen. So there's the overall backdrop. 2015 was a bad year, affected mainly by commodities and slower growth in China. 2016, the expectations are for something a little bit better. That may be a little bit too optimistic, but certainly maybe we've kind of bottomed out a little bit there. And here's just a representation of what's happened to China. China is, if you looked at it, kind of they've had growth rates all over the place, but recently they've been, if you look back to the 2000s or so, they've grown faster than 10% every year. And then starting in 2014, that growth rate began to slow a little bit, and we're now at something more like 6-7%. Again, a good number, good relative to the rest of the world, but certainly not what it used to be. And certainly it's not just that the growth is slower, but now they're trying to shift to more services-oriented economy and away from goods. And again, that's really busted up the commodities complex. Half the world's copper went to China for some of their major building programs, and now they're less interested in building and more interested in consumption. Those demands for copper and many other commodities are going down in price, and so that's why not just is the slowing growth rate important, but it's the mix of that that's really driving markets nuts. And again, one can argue, are the Chinese inflating their growth rate? Is this all some kind of mirage? And that's just so much malarkey. I really do think China has been an economic miracle here with some really nice growth for a large number of years. Have really done a super job of kind of growing their economy. And yes, like anybody else, are there vacant shopping centers? Are there train lines to nowhere? Yes. But it's a $10 trillion economy. I mean, in any economy. In the U.S., we have Milwaukee, I recall, bridge project, the bridge to nowhere, and certainly that's been you're going to have that in any growing economy, that you're going to have some of those type of things. But and certainly some of their numbers from time to time look a little bit inflated to what kind of other sets of their data might suggest. But overall, I think they've done a good job, and I'm not expecting a total collapse there. Certainly, there's some lending's grown a little faster there, and I'd like to see it grow, and it certainly creates some risk. But again, even that's kind of more internal than exposed to a lot of the rest of the world. And certainly, the good news of all these slowing growth rates, besides the slowing commodity prices that we've always seen, is that interest rates are also very low around the world, and money's kind of a fungible commodity. And so while things look better here, and it seems like we should be raising rates here in the U.S., lower rates around the world have really kind of acted as an anchor on rates, and it's really kind of an unusual phenomenon to see rates this low for this long. And certainly the U.S. dollar has strengthened all of that. And again, here and there, it's caused issues for U.S. manufacturers. I mean, clearly we were at a period for a while in 2010 through 12 where, because of a cheap dollar, U.S. was actually exporting a lot of cars, which almost seems unbelievable to talk about. But certainly now as the dollar's gotten stronger, and that's, again, another fungible commodity, that we kind of shifted away from that. So the strong dollar certainly hurt different parts of the U.S. economy and export economy. But again, it's not the be-all and end-all, but it is indeed a strong dollar, and that is weighing on a lot of countries. It's raising their inflation rates and bringing ours down. Brazil, I saw the other day, was at something like 11% inflation. One thing that people often neglect, and we all talk about the export economy and how we're all more interlinked, but the U.S. is indeed much less dependent on exports than almost any other country in the world. We're somewhat more insular in that stage. It's certainly higher than it was back in the 60s, but still at 13% or so, exports are a far smaller percentage of our economy than just about anybody else, with the possible exception of Brazil. So that's really kind of an interesting phenomena. And so as people ask, well, isn't China going to ruin us? This is one of the things that I'd come back to people and say, no, not likely. In fact, the flow is the other way. China exports four times as much stuff to the U.S. than we export to them. So you got to get the dog and the tail straight here, that we're the ones that are driving their economy and not really vice versa. Let's talk about some of these demographic changes. Is that the first one? Yep. Okay. First of all, we've certainly got a baby boomer phenomena in this country, and we've had a couple of the depressions, another big event, that have changed the annual growth rates around, and it can really have pretty dramatic effects on the economy. And again, dating back to the 1900s, some years birth rates might be as low as 2 million people born in one year, to kind of at the peak of the of the baby boomers, we were up around 4.4 million births in 1 year. And shockingly, a lot of economic data depends on a very kind of narrow range of how old people are. You know, how many schools you build is kind of dependent upon, elementary schools are dependent on, well, how many people were born between these 2 years. And it happens in a lot of other phenomena to know where we are in all what I call birth cohort. What I mean is everybody born in the same year. You know, I'm kind of in an era where there were 4 million of us, and where are all those people right now on that curve? Well, we're on the part of the curve that is beginning to collect Social Security. And so that's certainly moving in an upward direction. So as we see Social Security go up, what's driving it? Well, the number of 62-year-olds, the average age when people take Social Security. If you look at that, if you go right under that age 62, look at that red bar right in the middle there, and that's where we are right now. And the number of people turning 62 each year is going to increase for the next 5 to 10 years. So that's going to drive up Social Security, and that's probably one of the examples there that I think is very interesting. Another one is, flip over to the very next purple bar, the age 50 people. We'll show in a minute, age 50 is the year when consumer spending peaks. You know, you got kids in school, you got your best incomes, that tends to be your best consumption years, and you can see maybe some of the slowing we're seeing is because the number of 50-year-olds is down. There's tons of things you can explain off this graph. Take it with you. It's the most important graph in this whole deck. Next. And again, I talked at the very beginning of the talk, and this compares GDP growth to population growth, and you can see in the 50s we had high population and high GDP growth, and remember they're on 2 different scales there, so be careful. And certainly now the population growth is really slowed down under 1%, and certainly that's weighing on the GDP. So this woe is us, we're not investing enough, we're terrible investors, the Fed has screwed us up. No, the answer is a lot simpler. We're just not growing as fast as we used to population-wise. And this is not just a U.S. phenomena, but a world phenomena. Emerging markets, developed markets, the whole economy, all of us are slowing. And so certainly this is not a U.S.-only phenomenon. And certainly one of the reasons I'm optimistic about wages continuing to grow and being a driver of the economy, again, this is looking at, I'm playing with numbers a little bit here because I'm using people native born, so this excludes the immigrant population, which is not totally insignificant. But if you look at just native borns, right now, the number of people in the working age group in 2016 is actually scheduled to go down. So after the turn of the century, when we were probably adding about 1 million to 1.5 million working age people every year to the economy we had to find new jobs for, we're now in a world where we're shrinking the working age population by a couple of 100,000. A pretty profound impact. One of the reasons we think the unemployment rate is going to go down, one of the reasons we think labor rates have to go up. And what's interesting here, we do the population growth. The kind of really short blue bar is the under 18-year-olds. The red bar is the typical what you think of a consumer. That is the 18 to 64-year-old, and those big, tall green bars are people 65 and older. And you can see huge growth rates there over the next few years. Not so much in the other categories. Why do we care? Next. Here's that proof that I wanted to show you. This shows you the consumption dollars per household based on age. And you can see that middle set of bars, people between 45 and 54 are the biggest spenders. And then once people kind of reach that 54 or so, then we go downhill fast in terms of spending. And so even if the population were to stay stable, the fact that we're getting older as an average population each year is a very bad thing for consumption. So that's certainly one of the things that will weigh on some of my more optimistic things. It's why we may not need so much more physical capacity, and maybe why GDP growth never gets to 4% again. Again, another very key concept and key slide to look at. Next. That's it. I promised you a quick answer or my quick thoughts. And again, these are a little bit off the cuff, but you know, why have we started off this year so bad if you know, kind of the U.S. consumer is just fine, and I'm saying no worries, let China do what it wants. I want to be a little careful there. I'm not quite that lackadaisical about it, but certainly I'm relatively positive on the economy. What's with the market? Certainly everybody's very worried about China. And again, it's not that their economy, you saw in the graphs, it's been slowing for some time, and it's not that the data is so horribly worse than it was, but it is a little bit that they've levered up so much, and it's a little bit a crisis of confidence. You know, they've kind of managed through a lot of predicaments. They got through the recession, the Great Recession, with hardly a missed heartbeat. You know, they were considered the world's best economic managers, that maybe the planned economy was the way to go, and the U.S. let things go too laissez-faire. And now all of a sudden, every decision they make seems to be a bad one, and they change their minds every other week. And that crisis of confidence is probably heard about China more than anything else. And again, I pointed out why maybe it's not a big deal to the U.S., and it may not even be a particularly big deal to Europe. It is a bigger deal to other emerging markets. There are some worries that, you know, maybe as they've levered up, that maybe there's a risk like there was in our mortgage market. I tend not to think so, but it's probably going to be less prone to spread. The rest of the world doesn't own much Chinese debt. It's more of an internal problem. So I am a little less worried, but somehow, somewhere, you know, maybe some big U.S. bank lends a lot of money to Brazil, who has a lot of business in China, and maybe that's how it creeps into our system. It's hard to say never. You know, I mean, there certainly were a large group of people that kind of saw some issues in the housing industry and the subprime mortgage market. That's 2% of the market. You know, it's not going to kill us in the same way I would say right now China is only 1% of our U.S. exports, so how can it be a big deal? Again, things have a way of having more knock-on effects than we might realize. And so certainly people have a right, especially when economies soar up and down, that the subprime probably wasn't going to make a difference. Certainly some of those claims about China probably ring a little bit hollow when economists say the same thing. And certainly, you know, we talked at the very beginning about all those things that make the quarters in terms of GDP volatile, and I'm afraid we're unfortunately set up for a not-so-good fourth quarter GDP report. I think we may be lucky to grow 1% again in the fourth quarter. The year-over-year number will still be 2.4%, and again, inventories will be a big factor, and those nasty weather effects will certainly weigh on some of the numbers too. So, and the unfortunate thing is that people say, well, China's slowing, and now the U.S. GDP looks crummy, and it all fits together, and our world is falling apart. And I think that's a little bit of what's happening, and valuations were probably a little high to start with, although I could have said that any time for the last 3 years. I don't think that the Fed raising rates is the cause. A lot of people are saying, well, see, they raised their rates, and the markets immediately went down, and I don't think that's it at all. I think some of it might be that people had profits and are taking some of those profits in the first of the year now as they move into the next year for profits. So I think that's certainly probably one of the things that's out there. So again, I can point to things that are clearly making the numbers look bad and scaring people, but I keep in mind that long-term employment number that's out there, that ongoing labor shortage issue that's out there, all as things that make me think the bottom is not falling off here, and that there's still a lot of room in the residential housing market, and those things will all keep us from some type of collapse here. But again, that's just one man's opinion of kind of what's going on here, and I didn't want to ignore it either. So with that, we're right at our hour mark. Let me stop there.
Okay. Well, Bob, thank you very much. Most interesting. Now, I would also like to remind folks that you can enter any questions you may have for Bob at this point in the, into the chat panel. And while I'm waiting, I do see there is a question there, but to give you all a chance, I also have one piece of business that I need to do. So, and you'll see that I open that up on your screen right now. It's a polling panel, and IB's management has asked that I run this in each event. There are 3 short questions and 2 are multiple choice, so we try and make this quick. Also notice there's an input field. Don't put your questions for Bob there because we won't see those until after the event ends, but it does make a great place to put any suggestions you might have about other webinars you'd like to see covered. Poll is about to end, so please click that submit button now. And by the way, you can also send those comments or suggestions to me at webinars@interactivebrokers.com. Okay, by the way, you can close the polling panel. Thank you, everyone, for participating. Very helpful. Now, you can use the X that's included in the title bar or simply double-click the chat panel to expand that information or expand and send any of your comments at this point. Well, it looks like there's just one there, Bob. Back to you.
Yeah, and let me tackle that one a little bit. Certainly that world poverty question is interesting, and it relates to another question that I get a lot is that, well, everybody's whining about China's 6% growth rate. Well, you know, that's wonderful. Everybody should be glad to have it. We point out that part of that is a poverty issue. You know, we talk again and again, I'm going to rough these numbers out for you, but the U.S. economy is an $18 trillion economy. China's about $11 trillion. It's about 2/3 the size of the U.S. economy. And again, very round numbers, they have roughly 4 times as many people. So while on a pure numbers basis, they're you know, each year they get a little bit closer to the size of the U.S. economy. As the questioner points out, there certainly have some very, very poor people in China, and they've got some real issues there that people in the cities are doing quite well, thank you, but the people in the sticks not so well. The people that are kind of stuck in the agrarian economy, and how they manage that transition is really, really tricky. And that's what, if they kind of only have 6% growth, they're not going to be able to migrate as many of those people, and their expectations are high. You know, the Chinese people have traded off a lot of their freedoms, knowing full well that they are doing that for a chance at a better economic life. And certainly the government occasionally has played a very, very heavy hand in that. And now if they don't produce results, that certainly creates a certain sense of results, and 6% growth isn't enough to move those people up to a higher level of income, and that's kind of what the problem with 6% growth is. And I don't know if it's 6 or 5 or 4 is the magic number there, but certainly that's kind of what's going on there. And I think that world poverty is an issue that is very real, and certainly one of the things that's happened is we've kind of spread out some of those incomes a little bit more over the last 10 years with that higher growth in some of the emerging markets. But boy, we've still got a lot of ground to recover, and certainly that will, some of the things that are happening in emerging markets will probably help offset some of the declining population growth we're seeing in Europe and our slow population growth here. Although I do point out that China, because their one-child policy, also has no population growth right now either. But places like India, Indonesia, or whatever, may be where we look for growth in the time ahead.
Okay, well, I'm not seeing any additional questions come in, so I want to thank Robert Johnson. Bob, thank you so much for today's presentation. Thought-provoking and very interesting. And by the way, for anyone who wants a copy of these slides, they will be available to you as you exit today's session. Simply watch for that drop-off link where you will see those pop up. You can review them, even save and print the hyperlink as well. So with that, we're going to conclude our session today. Thanks so much, Bob, and also Caroline for your help in putting together today's session. Caroline Brooks with Morningstar, and I'm very appreciative to Morningstar for the time that you've put into today's presentation. So with that, we're going to conclude our event. Thank you all so much. You can exit using the X in the upper right-hand corner of the screen. Have a great rest of the day and enjoy your weekend, everyone. And by the way, all, please do trade smart. Thanks all. Have a good one.